ahead and welcome on board Abhiram Eleswarapu. He's the head of India Equities at BNP Paribas as well. Abhiram, hi. Thank you so much for making time and speaking with us. Let's start with financials itself. SBI reported its numbers. The credit growth is expected to moderate to around 12 to 14% going forward. What's your take on the public sector banking space?
More than just public sector banking space, I would kind of step back and highlight the fact that financials is the one sector that we are most positive on at the moment. Till late last year, we were focused a lot more on just private sector banks and especially the large ones. But over the course of the past few months or so, we've been considering more outside of that space, including some of the public sector banks as well as NBFCs. So broadly, the thinking behind that is that loan growth across the segment, across the system is still pretty strong. Balance sheets are quite good. In fact, may not been this good over the past decade or so. And we think that banks are just getting more and more interested to lend beyond their prime segments. And all of this actually makes for a good case to be overweight financials.
Right. The other pocket of interest, or rather much the talk of the market, Abhiram, has been what you're seeing within the QSR space. And clearly a marked slowdown is what one has seen purely because of, I guess, the inflationary concerns. And, we could see that with not just the QSR numbers, but even the DMart, for instance, the price-conscious consumer segment. What is it that you are making of this now, and how one should look at investing within that?
Yeah, I broadly agree with you, actually. In fact, if you look at the whole consumer space and for a brief while focus on the price conscious consumer, like you mentioned, which would be more in the consumer staples area, I think this quarter is probably going to be the best quarter for some time, because not only do you have some amount of price benefit, as well as some benefit from lower raw material prices. But as we progress into the second half of the year, chances are that some of that revenue growth and the pricing gains that companies have taken may taper off. And raw material price, even though I think they will still remain benign, but earnings growth may not be as good as what we are seeing in this quarter. So in consumer as a whole, actually, we are seeing, what should I say, a two-speed kind of a situation where in some segments, especially in the higher end discretionary areas, volumes are still quite good. Think jewelry, for example. But as you keep going down the chain, and that's when both in urban as well as rural, we're starting to see some stress, and maybe that this is an area to be extremely selective going forward.
So that's the take coming as far as the QSR space is concerned. But just to talk about the point about the earnings itself, we are at the fag end of the earnings season. We went with very little expectations into Q4. But what's your take after the Q4 earnings season? Do you think the pace of downgrades is likely to slow down from here on?
Let's look at it this way. We're probably about 70-75% into the earnings season. And the results so far, at least from an earnings perspective, are more or less in line with what we've seen in the past, let's say 7 or 8 quarters. However, the top line has not been as healthy as we would have expected. Normally, by this stage, you would see half the companies would have surprised positively on on the top line. This has normally been the trend. That said, this time we're looking at more, maybe 30-35% of companies have done so. So what this clearly tells you is that earnings are being made up quite a bit due to benefit of lower raw materials and prices rather. And therefore, I would say this is a mixed kind of an outcome. But what's happening with India is actually beyond just the earnings of this quarter. If you step back and see today what we have globally is interest rates peaking. Second is the data that's coming out of our peer countries, for example, China, has not been as good as people expected. And the third bit is that oil prices are actually falling in commodities as a whole, in fact, and that is a benefit for an importing country like India. You put all of these three together and then say that earnings are more or less in line, and that makes for a decent kind of a situation for equity markets, at least in the near term. And that also explains why we've had about $6 billion of inflows in the last 3 months.
Okay, so that's a take coming in with respect to the inflows, and financials is one space you're positive on. But what's your take regarding, IT sector? Do you think the worst is already behind, or there's a lot more that is likely to come in the negative sense for the IT sector?
Well, going into the results, I was, of the view that that the results may not be that great, but that a fall in the stock prices may be a good opportunity for long-term investors. That view has not changed a whole lot. I still kind of maintain that view, and that's backed by the fact that deal flows are pretty strong. Indian companies are still gaining market share, and there's a whole digital angle that's still ongoing, and that's not as discretionary as people make out to be. Now that said, I wouldn't be surprised if we have another weak quarter. I mean, one more weak quarter, and after that things start to pick up. Now the big risk to this entire call is the fact that there could be a mild recession in developed economies in the second half of the year. Now, if that recession is any worse than just being mild, then I think that they could lead to a further round of earnings cuts. So simply put, I would be positive at the moment, considering that the fundamentals are still okay and stocks have corrected. That said, I'll keep an eye out for what's going to happen in the second half of the year and maybe play it slowly.
Before we let you go, Abhiram, then what should be a realistic return expectation from the equity market this year?
Well, our Nifty target is 19,250, which would imply like something like a 5% upside. And that view has not really changed. In fact, if you see what the markets have done year to date, it's probably flat to slightly positive. And so expecting some kind of a moderate return from here is not unthinkable. I mean, think of it. In the second half, you could also have a couple of risks coming up, right? At the end of the day, there could be a recession in the US. Interest rates have peaked, but the market is expecting rate cuts in the second half. God knows if that will really happen. So there are some risks as well. So it's good to have moderate expectations for the year.
On that note, Abhiram, we let you go. Appreciate you joining us on the show. Moving on and welcoming on board Siddharth